Maybe somebody can post a comment in the TradingView chat if the sound is good and the screen is visible. Oh, again, I'm sorry, I'm not sure. Okay, good. Well, this time I've just remembered to actually start recording. In my enthusiasm, I progressed, and the earlier one this morning appeared to be problematic in the sound. But microphone I've tested is good, so I think the quality should be good. But maybe due to the internet connection, the sound at times might not be of the acceptable quality. So this time, I've just started recording. Okay, so let's begin. So we are looking at main index of the US as Dow Jones. This is the monthly chart of Dow Jones, and I don't know about you, but many times when we see a historical chart, we think to ourselves, I was there and I wish I could have taken advantage of that. So many would have said something like that of the time when we produced the 2000 top and we declined into 2002, late October 2002. Then similarly, we had another opportunity here from 2007, 2008. Well, we are there. I think we have a very comparable opportunity like we had back over here. So hopefully we should be able to find method of identifying correct area for entry and a suitable instrument to trade with. And the idea would be is to manage the risk so that we are able to ride out a longer term trend and not have to necessarily be worried about short term noise in the market. So we are there. I mean, everything else indicate to us that we are potentially in a topping zone. We will come to that in a moment. Our main question is, are we at potentially a generational top? Well, on this particular chart here, which I have, is a Dow Jones on a quarterly. This is a 3-monthly chart, and that is simply to try and reduce the amount of details I show on the chart and make it a little bit more understandable. I may just also explain that Elliott Wave International, whom I have great respect for and have learned a lot of my Elliott Wave knowledge from them, they have been maintaining that from the low we had back in 1932 is the beginning of this current cycle. So they think that this top we had there in 1929 is the massive wave 3, it's a big cycle wave 3, and then we dropped down here in a big cycle wave 4, and we are now progressing in a big cycle wave 5. Exactly where it ends yet remains to be seen. However, Elliott Wave International have been saying that the labels I have applied is not what they suggest. They suggest that this is wave 1, wave 2, and then where I have put wave 1 in by itself, they call that wave 3. So they are saying that this is 1, 2, 3 going sideways as wave 4, and then this 2000 top is a wave 5. So they're saying that this is 1, 2, 3, 4, and 5. So since that is a 5, then they maintain that everything else we see is the part of a correction. So they subsequently have updated chart by saying from 3, where I have put 3, they say that's a big wave cycle 5, so this 5 should have been here and is finished, and they're saying that this is a WXY to here form a A, and then all of this is a part of a B, and we should be then expecting a big cycle wave C down. Now they may be correct, but I have considered this and feel that perhaps they are wrong for 2 reasons. One is there is an Elliott Wave guideline says that if you have an expanded flat, which is what this one is, i.e. We have potentially gone above where the wave A began, so it's an expanded flat, and the general guideline is 138% to the upside. So in other words, if we have a retracement coming down, so if I show you on this chart here where there's a less details on, so what they're saying is that if this was a wave 3, sorry, if this was the wave 5, then they're saying that this is wave A to the downside, then this is wave B, and this is C, and what that does, it completes one zigzag down to form a larger wave A. Then all of this is a wave B, and they say that we will then drop back to something like that. Okay, now I don't think that that is necessarily correct, because if that was correct, then the wave B should have really ended at 138% retracement of the wave A. So I'll just put that on the thing here. I think the chart's a little slower. So basically what it means is that if you were to put a Fibonacci retracement, and that Fibonacci retracement like that, once you retrace 100%, then it takes you back to the high of 2000, and then going 138% would have been really here. Well, in fact, even this one is 161%, and right over there is almost, not quite, but almost making, in fact, it's a 200%. If I just put that thing on, you will see it's a 200%. So I think it can't be the same cycle. It's no longer, it's gone beyond where it should have gone. So for example, that green line there you see is 200, so it's gone even above the 200. So I don't think this is the wave B anymore, and consequently I am taking the view that they will have to update, and they are perhaps wrong in assuming that that 2000 top was the major top. So the way I have labeled them is using the traditional technical analysis by using this trend channel. You see the in magenta or pink trend. Overall we have this crimson color, and you see right at the top is 3 and is a 4. So if you project that particular price action all the way, we've picked up the wave 3 high approximately. It could be adjusted a little bit, I mean, if need be, but I won't spend too much time in doing that. But essentially what we are saying is that we picked up a wave 3, so that's a channel. And when you look at this internal channel magenta, then I think it makes sense to say this is the wave 1, this is 2, but then instead of saying this is 3, I think this is the wave 1 of a larger cycle. So wave 1, wave 2, then this 2000 top I think is a wave 3, and then subsequently we have gone into some kind of a congestion sideways, and we'll see this a little bit clearer in another chart. So this wave 4 I think is a triangle that goes over there, and this wave 4 triangle is basically what I've tried to show in the chart that I've published just recently, this one here, showing that as a triangle on S&P 500. So if that's a triangle wave 4, then what we have then made subsequently is a wave 5, and I think that fits into everything else. So wave 4 is a triangle, which is a typical wave pattern for wave 4, and then we have gone up there as a wave 5. So what that does then is that it's a wave 1 in this bracket, wave 2 in bracket, and this top currently being formed is a wave 3 in bracket. That suggests that we will then come back to the lower end of that rising trend channel for a wave 4 in bracket, and then we will probably go back up for a wave 5. So in reality, the conclusion that we can reach to is that this is a significant top, but probably not the generational top that I'm talking about. The big generational top will come sometime later on. However, that will be quite some time off. It's not something that will happen in next few years. If I may also explain some time symmetry here, you see, for example, that if I measure from the low of this 1932 low and go up to this high, which is at 1966, 67, it's approximately 135 bars. Likewise, if I measure the 135 bars exactly from there and extend it forward, it brings me into the vicinity of the 2000 top. So 135 bars seems to be significant, and it appears it divides the entire rise up to that 2000 as into half. Then similarly, if I measure the low of 1932 and take it to this low, which is the low back in 1975, then that measures 170. So I'm projecting 170 from there, and what it does, it brings me around here, which is just around 2017. So in other words, sometime in the future. And then taking the minor ones in turn, is that if I take the same 135 and project it from where the market really took off, and according to Elliott wave analysts, they reckon that this cycle that started off in a wave 3 or coming to year 2000 actually took off from here, and all the rest of the sideway congestion was part of a correction period. And one could also just about put in here a small contracting triangle like this, and that contracting triangle marks the end of that correction. So that's where the cycle took off from there. So if we measure, as I said, 135 from that particular time where it started, it brings us around April of this year, or January of this year. So we are within a ballpark figure, as it were, in terms of time. The actual top, if we look at it, it happened in May 2015. But we are in a very close proximity, and several other time factors come into this sort of area. So either the May 2015 was the high, or we might just perhaps go back to retest it. So either of those things are possible, but its time window is where we are now, both in terms of the time symmetry we have just measured on this very large 3 quarterly time period. So from this perspective, all we need to conclude is that we have an area where the potential significant top is placed, and possibly we may decline into a lower area of around 2009 low, which would bring Dow into somewhere around about 6,000 area. We may even come down below that. If we look at this as a megaphone pattern, then it's possible that we may even come down below that. And what sort of times will we have is based on this time cycle here, which is measuring from the high of 1929 up to that pivot here is 182 bars. And if you place the 182 bars going across, it suggests that maybe we might have a low somewhere around 1920, either middle of 1920 or sometime in the beginning of 1920. This is again, as I say, is the quarterly chart. It could even be latter part of 1920. We're not saying that's going to be the actual time when the low will form, but just looking at with the geometry, it appears that if we have topped and we start moving down in a zigzag formation, it is possible that we can produce this zigzag by 1920. And this time that we came here at 1917 might be an intermediate low within that cycle. So we could drop into 1917, maybe about a year time from now, then perhaps go back up again as the retracement, and then make another drop to complete this zigzag to the downside, which I think will be a big wave 4 in bracket, from which the market will then probably run up if my counts are correct. If I'm wrong, then this wave 4 will not hold, and what Elliott wave principle I've been saying is will hold true. In other words, market will decline much lower, but I think that will be spared or stored for later period. The other thing to take into account is this MACD here. Now generally the highest MACD reading should be in a wave 3, so this one confirms that. If we assume that to be wave 3, if we think that this was 3 according to Elliott Wave International, the MACD is really way below that. So again, another reason why I think my labels are correct and Elliott Wave practitioners or Elliott Wave International are wrong, and they'll have to revise their chart to bring it in harmony with the current price action. So if this is wave 3, then it makes a perfect sense of me accepting that this decline is wave 4 into this triangle, and then what we have gone back up again to make a double top is a wave 5. And it's not very clear, but in fact if you look at it, there is a divergence on the MACD, just about noticeable, you can see there. So there is a divergence on MACD. So I think everything else that I'm looking at on this wave count is correct. So we are at a very significant top, but probably not the big top that we are waiting for, which will happen I think sometime later. My estimation is that we'll be looking at somewhere in the region of 1927 for that to happen. But I think this is going to be significant. If it resembles anything like we had in 2007, 2008, then I think this is a significant opportunity, probably even larger, because we have a high starting off from much higher level. And to drop back to back to 2009 is a significant drop in the market over the next couple of years. If we were to look at this in a bit more detail, and we will use S&P 500, then we note that the triangle I was suggesting is this one here, and that we have some other symmetries we can look at, and these are also very interesting, helping us to identify an exact turn in May 2015. So this particular drop, if any of you know what it is, I wasn't involved in trading financial market at the time, not in the current way anyway. I had a small little experiment leading into 1987, but this 1987 was a big drop where within a day market fell in excess of 20 or 30% in a day. So all that big drop you see is mostly within a week took place, although on a monthly chart it suggests that there were 2 or 3 months, but the bulk of that drop happened within a week. So if we start measuring from there, then the first higher low, where the cycle could perhaps initial cycle could end, is a 76 bar. Then applying the 76 bar from there leads us into the top of 2000, and that's why I think it's significant. Although this is 71, but it's very close to the other cycle I've noted. So this one happens to be 5 bars short. Okay, if you were to take this second lower high, which is also in the same area, almost like a double top, then chances are that it will measure 76. So 76 is an important measurement. We apply the 76 from the low back in 2002, and the low in 2009 is exactly 76 bars on this monthly chart. Then again we measure 76 from there, and we go to the current period. It brings us into a time period which is about July 2015. And if you look at the actual low to taking place, it happened in May 2015. So I think the time window is very, very close, using this 76 bar as a measuring yardstick for cycles. And then the interesting thing also is, if you measure from the high of 2000 up to the high of 2007, we have 91 bars. And if you plot the same 91 bars from that high to the current, it brings you into the area where we topped, approximately May 2015. So the 76 measurement and the 91 measurement together gives us an area more accurately than we did in the big quarterly time frame. And then if you confirm that with the traditional technical analysis, that is RSI, for example, with a trend line on RSI, we see that we have a negative divergence all the way. Every higher high formed lower high on the RSI, and we have a clear line where the market tried to breach above, but it failed. So RSI is now signaling that the current trend that is in progress or was in progress from 2009 could well be ending based on the RSI, and only the price will give us the confirmation. And if you likewise look at the MACD, MACD has clearly, just like on the previous tops, clearly turned down. It's clearly turned down. So one would conclude that we are in an area, in a time window, where we isolated as a potential high to take place. We have the indicators suggesting that maybe the high is already in place or very close. And then, like the other chart, where we had several measurements of Fibonacci. That's a Fibonacci on the price, application on the price. We have a price where, if you look at this one here, I'll bring it down. So if you use Fibonacci, you will notice that you can use a Fibonacci extension, which will help you identify when the price goes up beyond the origin of that high, where could it go to. So I'll take these smaller ones off, and you'll see that we take 100% of this one, take it back down, and it brought us just above the 200. If you were to apply that from the 2007 high, then you will find another Fibonacci lining up in there, which is 61.8. I've just taken that off, unfortunately, but you will see if you go back and put it on, you'll find it's 161.8%. So in other words, this one here, this one here, 161.8%. So we just shy of that, and it's in fact 150%. That will line up there. So both in Fibonacci term, in terms of the price extension and the time window, we are in a correct area. And also we have a further confirmation by this, either a trend line going up to meet there, or a shift pitchfork been applied, with that pivot there being in 1994, where the price really took up a sharp move to the upside. So all of these things are bringing together a potential high in the area, and we can conclude that if the price tried to go above the rising trend line, which could be potential resistance, the market went up above and couldn't really sustain its move to the upside, so it's fallen back into the range. And when it falls back into the range, it is vulnerable then to actually fall further, which could come back into this sort of area here. So it's approximately, say, 12,000 area as possibly the first leg down, and which is what we try to identify on this chart, where we could drop to something like 2017 from that, and maybe then retrace and then drop back again. And if the future time symmetry holds, then this 76 bar measurement comes into somewhere about 1921. It's hard to tell whether that will be the actual time or not. As I say, so far we are going by this regular reoccurrence of 76 bar yardstick, so it's reasonable to assume we might. But regardless of that, the Elliott wave principle also has a guideline which suggests that if this was a wave 5 of the cycle degree that we looked at on this one, wave 5 of a cycle degree wave 3 in bracket, then when it completes, it could drop back to wave 4. So wave 4 on cycle degree is here, around about 10,000 or so, because of the triangle. But more likely the lower end would be the potential target. So going back to this chart, then it's reasonable to assume that whether it takes up to 21 or not, we might not even get to 21. We might actually complete this whole move by much earlier. But whichever way it progresses, we have a potential drop, initial drop to a round level of about 1,000 on S&P 500, maybe a retrace and then drop back again to a lower level like where we had in 2009. So that's the potential in front of us. So looking at it now, we could say that we are in a very significant top. It could well be a generational top, but personally I think the generational top is yet to come sometime in future. And for many of you who are currently trading, and if you're like my age group, this might be the best decline that you will have now, which you will trade. If this one takes you to 21 and then you go back up and it takes you another 4, 5 years or 6 years to go back up, this second drop will be massive. However, I'm not sure whether I will still be trading myself, based on the fact that I am close to 60. So if you then add on all these years, you might not be trading, I may not be trading at that particular time. So this one for me is as good as saying it's a generational top. For me, that will be the last major cycle that I'll probably actively trade, at least for the major bearish cycle. Then at the end, depending on when it comes, either in 2021 or around about 2019 or somewhere, then we will be able to ride it back up, hopefully. So anyway, so that's basically the time frame we are looking at. But this is simply looking at it from the point of view of basic Elliott wave labels and analysis, a Fibonacci time relationship we looked at, and some kind of a time symmetry using the measurements of the 76 bar that appears to be regular recurrence between significant lows and this here 91 bar between the two highs. Are there any other form of analysis that can help us either validate this or clarify for us? Now, in this chart, it is a chart of Dow Jones Transport on the top and then Dow Jones Industrial on the bottom. And if any of you are familiar with the theory of Dow Jones, it's called Dow theory of either confirmation or divergence, meaning that when Charles Dow developed this particular theory, or his observation was that the transport index, the components of transport index are also components of Dow Jones 30. So the idea was that they should be both moving together, either up or down, in sync. And when you see them moving out of sync, then potentially they could either give you an early warning of possible exhaustion of the trend, either to the upside or to the downside. So they should be confirming, but if they do not confirm, then they are basically saying it's a divergence. So to illustrate, we look at this top here in 2000. On a transport, we made a top exactly where I've drawn this line here, and that happened to be month of April of 1999 is when the high in transport was scored. But you can see on a Dow Jones, we continue to make a higher high. So we made a high in December or January of 2000, December 1999 or January 2000. So there was a difference between the high that was posted in transport, and that was in April. So you can say it was almost like 8 to 9 months warning ahead that there could be a potential turning or exhaustion of the trend in the making. And that is what Dow Jones calls it, or Charles Dow calls it, as a non-confirmation, meaning that the Dow Jones continued to make higher high, but it was not confirmed by transport index. And then similarly, you can see here, for example, on the way down, you can see that Dow Jones index made a low in October 2002, but the transport did not actually make its low, its respective low, until later, and that was in March 2003. So again, there was almost like a 6 months, 5 to 6 months time when the transport made a lower low, but it was not confirmed by the Dow Jones Industrial. And therefore we have a divergence. So potentially the decline coming down got exhausted, and then we had a trend to the upside. And we can continue like that, and we can see the same observation again in 2007, 2008, where the Dow Jones actually made a high in October 2007, but the transport went on to make a new higher high, and that was not confirmed by Dow Jones Industrial. It made a lower high. So that particular trend we were looking at is now exhausted, and we are now coming back to the downside. So following the same reasoning, we are now at a level where other technical analysis tells us that potentially we have reached the top. So if that particular top was formed, then on transport you can see the actual high was posted in November 2014. Now I have some chart analysis where I have been anticipating a potential high of this nature sometime during 2014, between mid 2014 to latter part of 2014. And unfortunately, whilst the price actually didn't confirm that, but the price hasn't really gone very far from that, wherever that price was. It was on Dow Jones, it was around about 17,000, and then it went on to make a final high around 18,000 something, but it's really not that much further away. But the transport actually made a lower high. When Dow Jones made the high in May 2015, transport clearly made a lower high. So transport is not confirming the higher high of Dow Jones, meaning it's an early sign or potential warning that the trend has in place could come to an end, could be coming to an exhaustion. So how do you apply this? What we need to now do is we have this as a pivot high on transport. So in order for the bullish cycle to resume, both indexes now need to climb back above their respective pivot high. That means the Dow Jones need to climb back above the high of May 2015, and the transport need to climb back above the high it posted in 2014. So will they do that? That's a question. Will they do that? I think somehow they will fail, for the pure reason is we are in a cycle of creating lower high and lower low on the transport, and we have these spike lows in the Dow Jones, which apparently is currently forming a base, whereas the transport doesn't have anything like that. Transport's got a spike low here, which was created in February, but it doesn't have anything during that cycle except this previous one spike in October 2014. So it's really below the resistance. So for this one to climb back up there, I think is asking for quite a lot, and the Dow Jones is being held up, and probably they are in a retracement mode for the time being. So my perception is that the retracement would go on. If you look at the previous chart here, the retracement might go on, where we may come back and retest, not necessarily the top, but come back and retest this higher level, somewhere about 17,000. So if that was to happen, then we may get both of them failing. So for example, if I put lines on them now to indicate what I mean, is that this Dow Jones transport could probably go up there as a form of retracement and then fail. And then likewise, we have the Dow Jones Industrial will similarly try and make a move back up and fail. And overall, you might be aware that that area is forming some kind of head and shoulder pattern, and it is very, very similar, not exactly the same, but very, very similar to what you saw taking place here. Here we didn't have a clear head and shoulder pattern until much later, but basically the market just went sideways for quite some time. And if you see how long, then it will give you an idea why we are going in a similar way. So from here almost up to here, before the real bear trend began, it spent nearly 18 months to 22 months. And if you look at here where the price came, and basically now we are just going sideways, it's almost like 20 months coming on to, in fact, if you measure just right up till now, it's only measuring about 19 months. But maybe another 2-3 months of possible retracement to the upside might just about complete the entire congestion pattern, and we will get on this occasion a rather pronounced head and shoulder pattern in contrast to what we had in 2000. And this is somewhat different from the 2007, where we had like a sharp top and we just resumed to the downside very sharply. So I think we have spent quite a bit of time, and the market is currently very volatile, where you see often 200-300 points up or down on a daily basis, several times in a week. That's because we have a situation where people are confused. Is this just a retracement and congestion along the longer bullish cycle, or is that potentially a top? and nobody has that answer. Not necessarily even highly talented and well-resourced organizations like the big banks and their traders or analysts. All the big institutions are currently battling for, or jockeying for position to make sure they're on the right side of the market, and that's why you often see sharp sell-off and sharp bounce back. It's synonymous with what was happening back here. You don't see that sort of a thing where the trend is in a nice defined manner. You see some big days up or big days down, but you don't see this big up and down sideways chop that happened back in 2000 and is happening now, if this was just a correction. So my perception is that other analysis we just carried out on Dow big time monthly and quarterly period, and looking at this non-confirmation on Dow Transport and Dow Index, seem to suggest that we are possibly in a process of topping around here. So it may go on till April, maybe even May, June, July, before this whole thing sorts out, before the real trend to the downside will begin, and then it will become very evident that we have resumed the downside. An additional analysis that we can also carry out is this Dow index on the top, S&P 500 in this middle one, and this one is the ratio of the two. So in other words, we've simply divided S&P 500 by Dow Jones, and it is interesting in that the S&P 500 has many more other companies which are not part of the industrial Dow Jones Industrial, and therefore it represents the smaller corporations, not the very small, but the medium-sized corporations, in comparison to big mega multi-million multinational corporations. And sometimes, just like the Dow Jones and transport giving non-confirmation, we have a non-confirmation here in 2000, where, for example, the Dow Jones topped first and it continued to decline. Sorry, S&P made top first and it made lower highs. Dow Jones continued up and made higher high. And we have the same situation happening now, but not so pronounced. We have, for example, the top in both of them happening on the same month, in month of May 2015. And since then, we have S&P 500 appears to be more weaker than the Dow Jones, but they're still fairly well held in that area. But the ratio tells us something different. What this ratio is doing is simply dividing one by the other, and in order for this chart to be useful to us, we ignore what's happened in the past. Broadly speaking, they were market both moving together, as you can see, but in a different proportion. In that particular charge up, it was the big multinational corporations were leading the charge to the upside. And one of the reasons for this is back in 1987, 88 and 1990, you will know that the prevailing interest rate throughout most of the developed world were very, very high, along with the inflation. When the smaller corporations often struggle to raise adequate finance for growth, and similarly their profit were often disproportionately used to service the debt level, and the bigger corporation didn't have that to hinder them. So they made good progress in the environment where there were high interest rate and high inflation. However, as we approached the latter part of 1990 and coming into year 2000, the interest rate started falling quite dramatically in comparison to the historical levels. So from then on, it appeared as though the smaller corporations were no longer shackled by the debt problem. So then the ratio chart now becomes very useful to us, because what it is indicating is what it should do, i.e. the smaller companies are more riskier. So when the market is in a bullish cycle, then you expect the hot money to chase the smaller companies, because that's where they're going to get bigger return. Where the bigger corporation can move, but they can't move at the same pace as some of the smaller corporations. So they will be chasing the money, and the market will lead to the upside by the smaller companies. Then similarly, when the market is in a bear trend, it is fearful So many people will actually sell off their higher risk asset and probably rotate the money back into the more safer and stable companies, which is the multinational. So in this particular idea, it appears that on the drop, S&P 500 was dropping faster than the Dow Jones. That's what this ratio chart suggests. Then again we started a bullish cycle, and you can see S&P was rising faster than the Dow Jones. And similarly, during this contracting and this triangle period, we again had same. Is the down to the downside, S&P was leading. To the upside, S&P was leading. So coming to the current time, is S&P has now led the charge, and we have reached the top end. And see this declining trend channel of the ratio chart? We are in the upper end of the declining trend. So if this upper end holds, then it is likely that we may see the ratio now reverting back to the downside. And if it reverts back to the downside, that means the S&P 500 is likely to fall faster than the Dow Jones. Hence the ratio will also drop. And interestingly also is the ratio had a potential resistance back in 2005 when the price was still rising. So we could have got early signal to say maybe we should be on the lookout for exhaustion of the trend, because the ratio has now reached the potential resistance level, like here in the back where we had potential supports become resistance, So we've hit into the same area. So this ratio chart suggests that we could be at the top end. It might not necessarily actually give you the exact day of a turn, because we already have a top in May 2015, and the ratio formed its top a little bit later. Sometime it posted one higher earlier on, but in this case the high on the ratio was in September, August-September period, few months later on. But we can see now clearly that if this ratio was to fall, then we would be looking for a market to decline. And taking a different market, I understand the sound is not good. I assume it's probably the internet connection for some reason. So unfortunately, I will just have to carry on and cover this. And I'm also recording this on my PC. So hopefully, if the sound is poor eventually, we may discard this video, and I will then substitute it with the one we are recording on my PC. So on this chart, which is a Nikkei index and Dow Jones ratio, and generally you expect market to do something similar across the pond. So here, ignoring the chart up till 2003, we see that we had been declining, where the Nikkei was falling faster than Dow because Dow was going up at the time. And then subsequently we find that on the upside the Nikkei appears to be leading, and likewise on the downside the Nikkei appears to be leading. So again we have a similar declining trend channel, and we have a potential top on this trend, expecting the ratio now to revert back to the downside. And if it does, that would suggest that the equity market is now going to be declining, which reinforces our conclusion we have already reached from the ratio of S&P 500 and Dow Jones we just looked at. And if you look at the Nikkei index itself on its own, then on the Nikkei index, the bottom one is a Dow Jones index, the top one is a Nikkei index. And if you have any knowledge of what what Nikkei did, Nikkei formed an all-time historical high on the eve of 1990 at just below 40,000, and it's been declining ever since. So based on the Elliott wave, I have a clear 5-wave move to the downside, which is not shown in this chart because it doesn't have the data, but it's moved to the 5-wave down to the downside to here, which I've labeled wave A. Then we have a zigzag retracement for wave B, and then this appears to be like a falling wedge. You might be familiar with that pattern, falling wedge, and often that falling wedge in Elliott wave suggests it's the completion of that cycle. So if it is A, B and C completion of cycle, then I think it's completed a larger zigzag to the downside. So then we would expect a zigzag retracement to the upside, which is what we have. So we have wave A in bracket, retracement back here is wave B in bracket, and then we have gone up in a wave C. So that completes the larger degree, larger cycle wave B. So I've made that into bracket A, square bracket B. So what we should have now to the downside is possibly either a zigzag down or a 5-wave down. If it is a proper C, we should have a 5-wave down. However, the alternate would be that this is a bigger cycle A, this forms a wave X, and then we have another ABC to the downside. But the conclusion of this chart is that we would be looking to retest the 2009 low on Nikkei index in due course. And if Nikkei index did that, then same with the Dow Jones, is the Dow Jones would likewise turn to the downside and would come back and retest the 2009 low. And another market that we may also consider, which is one of the European index, and that's a German DAX. And in the German DAX, we have the pattern we looked at in the S&P 500, and that is we made the top in 2000, and then the intervening period is like a big triangle like here. So this was the low we had back in 2002, 2003. So if that formed wave A, then we go B, C, D and E. It's like a triangle where you need 5 points. So in this we have a 5-point also in the DAX. So from this point they both began their last leg to the upside to complete the cycle. And it appears that the German DAX actually formed a high earlier. It formed the high in April 2015, and then we formed a high in May in S&P. So there was about a month difference between the two in which they formed their respective highs. So all these different markets are suggesting the same, is that we are at a significant top, and potentially the price action since then could be an early stage of development of the bearish cycle to the downside. So we may, for example, here we could be forming like a first falling wedge, and if it is a falling wedge, then we need a 5 points. So we go like 1, 2, 3 here, retracing back for 4, and then dropping back for 5. So if we have that, then it would be fantastic, because then after that you needed like a zigzag retracement to the upside, and that retracement could finish maybe by about July time sometime, and then we could commence our real bear trend to the downside. So I'm looking for this wedge to develop, ABC retracement, and then basically a downtrend will be very, very discernible by that time. It would not be difficult if we see that. So we just need to study the future price here for a while for an absolute confirmation, but we are at a very early stage of this market developing a very strong, quite a noticeable down cycle, which would take us back to 2009 low probably as a minimum. So taking all this market to account, how do we benefit from this? What can we do? Now, if many of you are trading this market, you will know that trading them, unless you're monitoring the market daily and perhaps intraday, it is hard, simply because if the market moves by 200-300 points, for example, it becomes very difficult to actually manage those sort of things, and you can't have a significant position. Because if you get it wrong and you get adverse movement against your trade, you could have a drawdown on your account and all this kind of thing. So in order to trade this successfully, especially riding out this big trend like this one here with all the choppiness along the way, I don't know of any other way other than using stock options. These are proper formulated, regulated options, in contrast to binary options that perhaps many people are familiar with. These are proper regulated options. They are regulated by exchange, and they're all cleared by the exchange, and people will trade throughout the world same series of options. So those are the options we are talking about. So how can we trade this? So this is an example where I posted this particular analysis in TradingView chat about 23 days ago, and what I said was that this LinkedIn had an announcement, or the earnings announcement, the following day on 23rd of February, and we are likely to find that this market will drop. In January, that this market is likely to drop. And what it did was completing the 5 wave to the upside. It then formed A, B, and we were hoping that this leg here was a part of a leg C, which would take us back to these levels here, 130 approximately. So we could have considered taking an option based on that knowledge, and on the background that the market itself is topping and likely to be weak. We could take this particular option, and rather than trading an option at the money, which are usually quite expensive, we would take it far away, out of the money, because we know the market is likely to drop significantly. So if we can take an option at around by 130 or maybe even 130 or 120, because that's where the market is headed. So we would be able to take a position without putting a lot of money on table. And then what happened was, once the earnings were announced, is not that chart, but it's this chart here. Is when the earnings were announced, you can see on exactly the same chart, we were there in this area. Earnings were announced and the market just simply fell, and it went well beyond the area we were identifying. So if you identified this particular trade, then we could have traded that, and you can see the option we would have taken is a 130 option here, 130 option for the month of March, and you can see that one moved almost by $19 on the day. So you could have got this one for about $1, and if you picked it up a little earlier, maybe at for 50 cents. The 135 options, they also went up by 22, so you could have got that one for $1. So this would have given you either 20 times or 24 times, and even if you bought it at $2, it would have given you like a 10 times. So I have done a short video on this one to explain this particular trade, but you can see the power that this could have provided you with, where you only risk very small, but if you get it right, it can give you a big return. And this was only a short-term play because of the earnings announcement potential coming out. We already had a weakness in the market. Amazon didn't do well after their earnings announcement. Google didn't do well either. So all of these technological stocks were struggling after their announcement. So that was the reason for considering LinkedIn potentially to drop, not as fast as this. I didn't expect this drop, I'll be honest with you, but over the course of few weeks we would have come down to that kind of area. So this is an example of the kind of way the options could be traded. The other example is this one here, is Domino Pizza. If I can get to the right screen, this one here. Again, I put this one out about a month ago in a chart, and I looked at this pattern, and based on the Elliott wave, this kind of pattern you see often in a wave 4 formation to the upside. So if this was wave 4, I was expecting it to go up. So my comment was that we could easily see 120 to 130 before it tops out, and sometime when these moves get going, they can go beyond that. So whilst this market was quiet, congesting, we could have taken an option for month of April, probably for about 50 cents again, or maybe $1, and just see what happened when the earning announcement came out last week. So if you were looking at, say, a call option on this side, and we were looking at 130, and say you managed to get that for $1, then the value of this one is 7. So for 1 unit of risk, it would have taken you to trade that particular position, you would have had 7 times the return. So or six times return. So it's like 600% on your original investment. But if you took it at 50 cents and managed to get that in, then you can see it's about 14 or 15 times. So you can see the power of trading option. That's what I'm trying to illustrate. Now, because of this earnings play, sometimes the market moves very sharply, like it did both in the LinkedIn and in Domino Pizza. But when we are riding a general trend, you might not get that kind of movement all the time. But often, over the course of say 3 6 month or a 9 month or 12-month cycle, many of the positions that you enter at a very low risk area could easily multiply by 10 and 15 and 20 times. I've seen that many times. So even on a modest, you could be looking for 3 4 or 5 times your return. And the idea with these is you don't have to worry about stop, you don't have to worry about monitoring these intraday to see what the market is doing and wondering what you should do with it. Ideally it is suited for people who don't want very stressful way of trading, or can't spend all the time in front of the PC, or have other obligations like secular job to take care of, or domestic responsibilities or anything like that, or just want to live life and not be tied to a screen. So I'm suggesting that these big trends we've identified, which are in the early development, could offer us an opportunity to trade low risk options, which could be practiced on a paper trading account if you don't have the skill, until you are competent to apply them on a live account. And learning, well, let's put it this way, in being successful in trading this particular method, you'll agree with me that it is very important to actually get the analysis right, because that then enables you to decide what stock to look for, at what price, what series of option, how long is the trend likely to be, and then select the option that you want to see which is the most liquid option, and consider the price that you think you might have to pay for it. So you can sort of plan all these things out, take your time to analyze the trade and decide which one you want to enter in. So that's what option allows you to do. And even if the price goes against you for a little while, as long as your overall analysis is correct, you don't have to worry about stops or about adverse drawdown on your account. So it's really very easier, very defined risk strategy, where you know exactly how much you're risking, and you are able to trade this profitably without spending excessive time in front of the PC or analyzing the trades. So to assist many of you who may wish to become mastery at trading this style, I am proposing to set up a group which will be launched from 1st of March, where we would go through the kind of analysis we've done as a big time frame analysis, and then we fill in with other complementary analysis in between to help us identify a short list of stocks. And there are many in the making. We might be able to go through later on if we have the time on this one. But shortlisting stocks and then trading them. So you will learn a multidisciplinary approach. You can see I have applied common technical analysis method, traditional technical analysis method, trend line, support, channels, momentum, Fibonacci's, etc. Along with Elliott wave. We've looked at ratios. We've looked at charts where they have a confirmation or non-confirmation, which are not the normal run-of-the-mill analysis many people carry out, and also cross-referencing these with other big economical regions like the Nikkei and German DAX, and we can go on to others to give us the theme running, which allows us to understand now that we could be facing a winter, for example, in a manner of speaking. So you then look for trades which would be more suitable for that particular environment. So learning this multidisciplinary approach of analysis, identifying correct trades and trading them, ideally with a group of serious and dedicated traders who are committed to succeed. It's really suitable for people at all level. So whether you are beginner or you are intermediate or advanced, beginner and intermediate will definitely have lots of things to learn from this, and even the advanced traders often may want to have a second opinion. Many do ask me and say, I think such and such, but what do you think? Have you got a chart on it? So I understand that many people either may not have the time to monitor all the market or are interested in second opinion. So I think I have quite a suitable a method of offering that second opinion and confirmatory analysis if that's what they were looking for, and most suitably for people, as I said, who don't want to spend all the time in front of the PC and do these stressful trading. And in contrast to many other trading courses you might have been on or were considering or have heard about, where either you attend for a one day or a weekend or sometime maybe over a course of a few weeks, but essentially it means having to pay out a significant large lump of money at the outset, like I have done in the past, and then after the course, you're literally left by yourself either to succeed or to fail. And many people then either lose interest if they don't succeed, or they find that it's hard, and what appeared to be very promising doesn't work anymore, or whatever the reason. But sometimes they don't carry through, and hence a larger community of traders often tend to fail even though they've been on many expensive courses. So what I'm proposing is a manageable membership of monthly subscription, where individuals will have an opportunity of experiencing the kind of analysis I've just gone through, along with identifying potential candidates and trading that, even suggestions of possible setups and particular series of options to look for. So you can then follow this through on paper trading platform, and when you feel confident that you may then want to apply the skill you learn into a live account, but understanding that you will accept the risk for that. So I think I have an option here, or proposition here, which will be of interest to many of you. It will be compared to having an apprenticeship. So over a course of a period, you assimilate things, learn and practice, and you are not pressured to learn everything within that short space of time in which normally most of the courses are offered. What will you get for this? So in addition to the form of analysis we just looked at, you will, for example, get videos like these that we presented here for any updates of charts, trade setups, which you can then review in your own time. Once a week, I will be holding over the weekend a live business briefing where we can do a big picture view, analyze the particular themes and the sort of candidates or the groups of candidates we'll be looking at and why. So you are then able to follow this through in your own chart analysis. These will be presented once a week along with the update of charts and video where necessary. Similarly, anybody who joined me for now, I will be also looking to launch these additional services later, but anybody who joined me now will be able to access them. Who joined me up till end of March will have an opportunity of accessing all of them, with exception of this last one, which is really a coaching program. I have not designed that yet, and when it is available, it will be a separate standalone product. But other than that, you'll be able to access all of this. The cost of this all is priced at, as you see on the page here at the bottom, is at £97 per month, which is a pre-launch offer, and then from 1st of March it will be at £127 per month. But what I'm also proposing is that for the first 25 who join me will be given an additional discount. So instead of paying 97, you will pay 87. So the first 25 who join me will get £87 per month subscription, and that will stay fixed at least for a reasonable period. And then the subsequent joiners will pay 97 up till the end of 29th of February, and then from 1st of March 127. So those are the terms I will be offering. I think there is a lot there for you to I haven't actually even shown you a lot of stuff that I do for big picture view analysis. They're not really suitable for short term, simply because of the time and labor it would take, and it's not justifiable for a short term. So if there are any questions, you can start posting them. Maybe you could use a chat box in the trading view, as many of you have not been able to post a direct chat using the Google Hangout. But if I was to give you, while you are posting those questions, some possible examples that we are looking at, and maybe almost ready to take a trade on that, is this Facebook here. I will probably swap over onto the monthly time period for Facebook. So this Facebook, you can see, has created, although we don't have a data because the IPO only started here, a bit like LinkedIn we just looked at, where we have potential completion of a rising wedge, and we appear to have completed that and started the cycle down. So in comparison to the initial drop, you see we are currently retracing, and during that retracement is if we get our options filled for shorting this, then it's a January 2017 option. I've already taken part position at 40 cents, so it's January 2017 40 put, which is 40 is lower down here. I'm expecting this to drop at least somewhere in proximity of that, or even if it comes to around about 50, that will be fine. I'll be happy with that. My option could multiply by several times the initial risk taken. But if this Facebook continue higher, then instead of a 40, you might be able to enter it at 30 cents or maybe even 25 cents. So this one is really now ready. As I say, I've taken initial position on it already at 40, and I've seen now this going up a little bit higher, so I'll be considering another one at 30 cents. Then if you look at others, for example, like some of the high profile cases, this is the CMG. You know, it's been in the news recently because of the potential health problems in some of their restaurants. Again, completed a wedge. It's fallen down quite sharply, and I missed the initial decline. I shouldn't have, but I've missed the initial decline. You can see now it's going back up in A, B, and C, and it could be running out. So if this is the first leg down, we could be looking for another leg down, which will offer another short opportunity, probably taking us back towards 300, 260, maybe even 220 area, back to this structural support we had previously. So that's another candidate. Likewise, if you look at Disney, very strong stock, and it's been moving up quite sharply, but now it is in a very, in fact, a lot of these stocks you look at are forming a similar kind of rising wedge. So this one also completing a wedge. I don't know whether this is complete or if the Disney is likely to go up a little bit. So if this goes up a little bit, then of course either that or retest the high, then that would be a really good time in which to take a short position. So there are so many stocks currently that I'm watching, and when time is right is to consider putting a trade on them. There's a question here regarding which option platform to use. I've made a video explaining this. I have currently two option platforms where my accounts are open. One is Options Express. They are a US based broker, and they are relatively expensive to trade with. They have a minimum $15 per trade. So when you're taking a small positions like one that we have looked at now, where they're only like a $400 or $200, then $15 to trade in and $15 for trading out is quite expensive. So they are expensive, but they are US broker, and they don't necessarily provide services everywhere. There are certain regions geographically that they will cover, and other areas they won't cover. Then I have a second account, which is my main account, with Options House, and again same with Options House. They will provide services in some geographical areas, and others they will not, but they cover UK, so I have a options account with them. They are competitive. Their basic fee is $4.95 for trading each trade. So you go in with $4.95 and you exit with $4.95, and then on top of that, it's a 50 cent per each contract. So options house, which is the these screens shots I've taken is from Options House. Okay, they originally this particular platform was with let's call it Trade Monster, and then Trade Monster and Option House have merged together, so it's now come under Options House. You need this platform because you need the data of a particular series. So if we were looking at Domino Pizza, for example, you need to know, what is the current implied volatility, which means how expensive the options are or how volatile are they. We also have a volume, open interest. This column here is the volume. So you can see out of some of them, there's hardly any position, so you wouldn't consider them necessarily. But you look for ones where there are large number of orders, which means that those are a place where there are good number of traders trading those particular series. So you and then the spread between them will be relatively narrow. Like in here, it's a screenshot, but on here you can see that, for example, this particular one, it's a 60 cent and 65 cent bid offer spread. So it's a 5 cent bid offer spread. But if you moved on to some of the others, you can see this bid offer spread on this one is 15 cents. So you need to be able to have some kind of an idea about where you want to look, and then see out of the range of 2 or 3 possible one which is the best one, both on how much the spread is and also whether there are enough interest open in that particular series. So Options House has this particular platform. It also has a platform where you can actually do analysis on a graph about amount of risk you're taking. I won't go into it now because I will have to log into the account, and I prefer not to do that now. But you can watch the video that I have released already, highlighting the kind of chart analysis you might want to do. And this is the different chart analysis, not the price analysis. Price analysis we can do on the charts that I was showing you here, for example. On here we can do the price analysis, but the option trading platform, you will need to do analysis based on the data you have on the screen as to which one is more preferable for you in order to take acceptable risk for potential reward available on that. And they also offer you this paper trading account where you can practice what we are talking about and learning. So in some countries where Option House or Option Express don't offer you this service, there is another broker called Interactive Broker. They actually provide services in Canada and many European countries, even Far East, Australia. I know that. And they are competitive on their cost for trading. My only reservation with them is that their platform is not as user friendly like the one that I'm showing you here. I have tried and I've spent some time. I found it very hard to navigate around. Some of the tools that you need, you find it difficult to locate them. But if you probably kept at it and you learned the layout, then it probably won't be impossible to use that platform. Many whom I have spoken to, they also use Interactive Brokers, but they do acknowledge the clumsy platform and difficult to navigate around it. Having said that, they have several tutorials. If you have the patience to watch the videos and learn what they are showing you, then they have several tutorials on their website. You might also be able to enlist help from the live chat. But because I have an account with brokers whose platform are more user friendly, for myself personally, I won't struggle with Interactive Brokers. But if these don't offer that, then consider Interactive Brokers. They're also US based broker, fairly big one. Failing that, in your own country wherever you reside, there will be fully authorized options, or rather stockbrokers, regulated by the regulatory authority of the country in which you reside. They will be licensed to continue offering that service to retail and professional public, and they will also offer you broking facility for US stocks. Like in England, we have Financial Conduct Authority, who are the official regulatory body, and many authorized brokers who are based in UK will allow you to trade UK stocks, and they will also allow you to trade UK options. But personally, for myself, I haven't found them to be competitive, so I wasn't interested in any UK brokers. But in the country where you reside, you may have an alternative brokers who are regulated by regulators of your country, and they will be able to offer you facility for trading options. But when you consider that, just make sure that you have a suitable platform. Ask them what they have to offer for a option trading platform to trade US stocks and indices. So hope that covers what you need to know on what kind of a broker you need to look for. And I hope the sound is still acceptable. But as I say, I have recorded it on my PC on this occasion because my morning session proved to be disappointment with the sound, and I think it's probably to do with the internet somehow. My microphone is fine. Okay, so any other questions? If not, then we are coming into now almost like an hour and 20 minutes, so we might conclude our presentation. Or are there any particular instruments you want me to look at to give you my view? Are you interested in any of them? Anybody? It's a shame that many of you can't join me on Google here, where you can see there's a chat box and you can actually interact with me by posting questions directly on here. When I'm sharing my screen, I don't look at this, but when I drop this one down, then I can show you what I need to. But if I want to check any questions, at least I can check here, and you can actually interact with me directly. So at the moment we are a little bit limited in that respect, but we will sort this out for the future presentations where you will be there with me on the same platform, and it will be much easier for you in order to post questions. So if there's no other question, then I will call this, bring it to an end. And just to remind you that the membership or the enrollment to the group will be released at 6 o'clock. So that's approximately 40 minutes from now. And the first 25 who join me will be able to get admittance for £87 per month. And then the remainder will join me at £97 per month until end of February. And then from 1st of March, it will be full price of £127. Okay, so I will close this session here, and then look forward to many of you joining me and then working with you, hopefully in developing our skill and developing our potential to take advantage of potential wealth transfer that's going to take place when the market makes a serious move to the downside. Okay, so I'll stop broadcasting here.